Hi everyone, welcome to the Fifth Person's live webinar. My name is Rusmin, and tonight we're going to talk about the value trap and how you can actually avoid those investing in those companies. Okay, just before we begin, please let me know whether you can see me and hear my voice loud and clear. Okay, so for those of you who are just tuning in for the first time, you can actually make some comments or ask questions during this tonight's webinar. All you need to do is just go to the chat box and let me know, okay, whether you can see me and hear my voice loud and clear. Okay, thank you, Jimmy. Looks like it's working well. Okay, we're going to start this webinar really soon. There's still 1 more minute to go. We will continue to wait for the rest of you to join us. Okay, so okay, cool. Patricia, Raguhan. All right, so I get to see a lot of your responses. Those of you who are still figuring out or first time joining us, all you need to do is just explore the tools. Okay, you should be able to see the chat box or questions where you can just type anything down there, and I'll be able to see your comment. Yes, Arthur, all right, Raymond, Tess, okay, okay, cool. The sound had disappeared. Okay, is it you're the only one, or how about the rest? Are you guys still can hear me? If you are having issue, please try to restart the webinar. Just click on the link again and restart the whole thing. It should be working fine. Okay, so a lot of you are so far so good. Okay, all of you, most of you, I would say all of you can actually hear me. Sounds good. All right. Okay, so we're gonna begin the webinar now. Okay, so again, those of you who just come in, just a quick presentation, okay, introduction about myself. My name is Rusmin, and tonight we're going to be going through about this thing called value trap. Okay, so this is something where I think a lot of us would not want to invest in such company because value trap are basically those companies that did not perform well in our portfolio. Okay, so in this tonight's webinar, I'm going to show you how you can actually identify those companies that potentially could be a value trap in the portfolio and what you should do with it. Okay, so as usual, this webinar is only possible if you have questions to ask. Okay, because I have prepared some contents for tonight's webinar. It's going to be you're going to take out about 30 minutes and going to leave the rest of 30 minutes for you to ask questions, and I'll try my best to answer all of them. Okay, so if you have any burning question that you have been keeping inside you, this is the best time to ask those questions. Okay, so again, like I say, I'll try my best to answer those questions. I may not know all the answers, okay, but I'll try to give you the best answer. Okay, so I'm gonna tune out myself. Okay, I'm gonna get you to focus on the contents that I have for you tonight. Okay, so later part, during the Q&A, I will again switch on myself, okay, so that you'll be able to see me again. Okay, so I hope you guys are able to see the screen. Please let me know if you can see the screen. Okay, so looks like it's working well. Okay, cool. All right, Ken. All right, I'm going to start this whole thing. Okay, everyone. So tonight we're going to talk about again value trap and different types of value trap. As usual, before we move on, whatever I'm going to share with you tonight is only for educational purposes. Okay, so there's no recommendation to buy or sell in anything that we discuss here in this video. Okay, so as usual, value trap are basically those companies that you bought. Okay, you thought that it is worth, let's say, $1. Okay, you estimated whether using your discounted cash flow model, discounted earnings model, or price to earnings ratio, or price to book, and then you kind of like estimate a value for the companies that you intend to invest, and then realize that later on, after you invested in the company, 3 years later, 5 years later, the share price did not move, regardless how many years you hold onto the stock. That stock refused to move up. Okay, instead it actually moved down. Okay, and this is where you get a value trap because the stock that you have invested may not actually worth $1. In fact, it's actually worth a lot less. Okay, so this is where what I mean by value trap. Okay, so even though when you invest in those companies that is you thought it is worth $1, but when you estimated wrongly, you given margin of safety of 30%, 50%, it may not be sufficient to cover those mistake. Okay, so because the share price just keep going down and down after you bought, and what is cheap can become cheaper, and this is where you get a value trap. Okay, so value trap to me, it is as good as a mistake, because this is where you lose your money, and it can be really frustrating because you've been holding it for years and then it did not perform. And it's one of the worst enemy for investors, and none of us want to have this kind of stock in our portfolio, because it is wasting our time. It is wasting, in fact, we will lose money, when we have stocks that, value stock in our portfolio. Okay, so I have some experience on this, and I'm going to share with you and how you can actually avoid the same mistake that I do. Okay, so when I say experience, I'm referring to my own observation on those companies that I know that is a value stock. So I'm just going to give you some example later on, real life examples. And of course, there are some companies that I cannot obviously mention the name, because I could get myself into trouble. Okay, so I will give some clues behind if I mention those companies, but I will not mention the exact full name of the company. Okay, so I hope you can understand. Okay, and there are different types of value traps around, and I'm going to show you how you can actually spot them. Okay, and the first one, in fact, is the most obvious one, is this thing called penny stock. Okay, so this could be surprising to a lot of you, but I find it quite amusing, because a lot of people, especially those senior people that I talk to, people who are in their early 50s or in their early 60s, I don't think age is the matter here, but when I talk to these people, usually they do not really have a good knowledge about investing. Okay, so how they define whether a stock is cheap or not, they really look at the price of the companies. Okay, so if you look at, if let's say I give you these three companies, A, B, C, okay, and each of them is trading at different share price per share. A is trading at $64, B is trading at $9.30, and C is trading at 20 cents. Okay, if you ask these questions randomly on the street, or people who do not know how to invest, okay, you ask them which of these following companies is cheap, okay, a lot of time people will come back and tell you that company C, because it is trading at only 20 cents. So in the past, when we're talking about buying share, we are usually in the term of lot. One lot is equivalent to 1,000 shares. So how they define cheap is because if they were to multiply by 1,000 and the amount came out to be in hundreds or thousand, less than 10,000, is considerably cheap, versus those companies that is trading at above $10 or $60 a share. Because if you multiply by 1,000 share, that amount becomes very big, and in their perspective, it becomes very, very expensive. Okay, so this is a question that is very basic, and again, if you go to the street and ask people this question, a lot of time you may get the answer as C. Okay, but those of you who know, okay, you can't just simply value a stock just by merely looking at the share price. Okay, because share price doesn't tell you anything. Okay, first you need to find out what is the company outstanding shares, and then when you multiply the outstanding share by the share price that trading at, you get the market cap, the value of the company. Okay, and that will depend whether what valuation the company is trading at, okay, and how much money did they make. And of course, those of you who are listening to this webinar, I believe most of you are pretty well informed. Okay, so you already know what is price to earning ratio, what is price to book ratio. These are the two most popular valuation metric that a lot of investors use to, give us some idea whether the company is trading at a expensive valuation or cheap valuation. Okay, we don't just look at share price by itself. Okay, but this is true. A lot of people may actually just look at the share price and then determine whether it's cheap or expensive. And this is, in fact, the most common mistake that I find those people who doesn't have financial knowledge in the stock market are usually the victim of this. Okay, because they like to invest into penny stock, because those penny stocks look cheaper, and when they invest in them, they are much more volatile. Okay, so I wouldn't say invest, but rather they speculate on those companies. Okay, so this is, I think, the most obvious value trap around. Okay, so if you just look at the company share price and then you thought that this company is cheap based on the share price alone, then that to me is the biggest value trap. Okay, so I hope none of you listening to this webinar will fall onto this trick. Okay, and I think, but what we can agree now here is that just by looking at the price to earning ratio, this ratio basically tells us that any companies that is trading at, let's say, price to earnings of, let's say, 5 years, okay, when we invest in those companies that have a price to earnings of 5 times, okay, we will get back our initial capital within 5 years. Okay, because for every $5 that you pay, the company earn $1, and this is where you get your return within 5 years, theoretically speaking. Okay, and price to book is basically if the company have a net worth, okay, basically all the assets minus off all the liabilities, you get the value of the company. And if you were to, let's say, find a company that is worth $1, book value is worth $1, and then the share price is trading at 50 cents, and this is what we call it as undervalue, because the price to book is only at 0.5. Okay, so this is quite basic. Okay, I just want to start off from here so that those of you who do not know what is price to earnings or price to book can actually follow along. Okay, so once you are, and this is where you got into fundamental investing. Okay, you look at the how much a company earns, what is the book value of the company, and this is where you start to do analysis on the fundamental of the stocks. Okay, and once you started this way, a lot of time this ratio will tell you that if you were to able to find those companies that trade at below price to earnings of less than 10 times, those are considered a good investment, because those companies are trading at a very cheap valuation. And if you can find those companies that trade at price to book of less than 1, essentially you're buying a discount to the book. Okay, so those companies that fit those two criteria are usually considered to be a cheap company, and this is where you may potentially find a good opportunity to make money. Okay, and I think a lot of people started investing this way. Okay, and I'm considered one of them. Okay, when I first started investing, I like to look at those companies that trade at low PE price to earnings ratio, so, and then also low price to book ratio, and I like to use the stock filter. Okay, and of course one of my favorite tools is CIMB, and they have actually this platform called the stock filter. Of course you can use other broker using other to basically filter companies. I mean, it doesn't matter which broker you use, and when you use the stock filter, you can actually key in a criteria like this. For example, you have price to book, where you can key in, you want to look for those companies that have price to book of less than 0.5. Okay, and this is basically the range that it gives you. And then we also want to look at companies that have trading at price to earnings of, let's say, maybe less than 8 times. Okay, and this is the range that I'll key in. And when I plug in this number, the stock filter allows me to filter out stocks depending on which exchange I'm interested, Singapore, Thailand, Hong Kong, okay, whichever the market you're interested in. It will give us a list of companies that passes those criteria that have low price to book of less than 0.5 and price to earnings of less than 8 times. Okay, so those are what I will consider as undervalued stock when I first started investing. And then from here, I will start to look for opportunities to invest. I'll go through every one of them, and then I will start to choose which of the companies that I understand the business, I think that the managements are reasonable, and then I may actually put my money in that. Okay, so I started that way. Victor also started that way. And then when we started to filter out companies, we actually came across this company in Hong Kong. Okay, so basically we filtered these companies in Hong Kong, and of course there are many others. I'm just going to use this company as an example, where we came across this company called 361 Degrees International. Okay, so this is a company that listed Hong Kong Stock Exchange, and we were looking at this company back in 2012. Okay, so we filtered out this company using the stock filter based on low PE, low PB, and it came out. And when we look at their financials for the past 5 years, this company is just amazing. Okay, if you look at the revenue, they have been achieving a very fast growth rate of from 300 million all the way to 5 billion in sales just within 5 years. Okay, and they also achieve a net income of 23 million all the way to almost 1.2 billion. Okay, within 5 years. Okay, and their gross margin has been improving from 20% to 42%, and net margin has been improving from 6% all the way to 22%. Okay, and their return on equity has also at a double-digit range. And if you were to show this result to any investors who understand fundamental investing or value investing, they will tell you that this company the numbers is almost perfect. Okay, because they are growing very fast. At the same time, they achieve a very good return on equity. At the same time, they have very little debt, and they are producing a very healthy net profit margin. Okay, so And this is basically 361 is a company that they they sell sports the goods like the shoes, apparel, basically the Nike versions of China. Okay, so if you go to China, you go to 361 store, you get to see all the sports shoe that they're selling, all the clothes, the basketball and stuff like that. Okay, so this is basically the equivalent of the Nike. Back then, this is what we thought. Okay, so they are all over the places. When I was in Shanghai, I still remember that I saw a lot of shop 361 degree all over the places. Okay, and the people were actually buying. Okay, at that time. And this company, of course, when we screen out, we realized, wow, we have found this undervalued stock because the numbers are very good. At the same time, they only trade at price to earnings of 6 times at the time when we found them. Okay, and again, stock like this, when they are trading at the cheap valuations, there is always the reason why they trade at such a low valuation. Okay, so now the question is, would you invest in these companies? Okay, so let me know your answer whether would you invest in those companies, in companies like 361. In fact, there are many more examples that I can bring it up, but I think this is just the point that I want to highlight to you. Okay, so of course, a lot of you will say yes, it depends. And I actually see a lot of yes in this, and of course some of you say no. Those of you who say no, maybe you already have experience investing in those companies, but at the time in 2012, my knowledge in investing was still I would say that I'm pretty naive. Okay, I know about investing, but at the same time, I have never made enough mistake to learn all these lessons that I've learned today. Okay, so of course it turned out that this investment become a sour investment for us. I think the yield for this company was trading at a also high single digit, and we decided to bought. Okay, back then, Victor and I were actually co-managing a fund, so we decided to, I think, invest about close to 500,000 in this company. Okay, because we realized that this company business is growing really very fast, and they were trading at a very cheap valuation. So we thought we found a bargain. Okay, so we bought into them, and soon after, 6 months later, those companies basically the cash that they have in the bank, they were actually showing about 2.4 billion. Okay, 6 months later, suddenly they realized that when they released the half-yearly result, and we actually noticed that the cash suddenly plunged all the way to 600 million from 2.4 billion. There was a huge sudden drop in cash. Okay, of course, when sudden drop in cash, usually we do not panic. Okay, let's say if the company will want to expand, they need to invest into new plant, stuff like that. So when we look into the reasons they're given out by 361 degree, we were very shocked because they say that the amount of money, the huge cash reduction from the company of almost, I would say, almost close to 2 billion was mainly used to provide the full support to the distributor and authorized retailers that is helping them to distribute all the clothes, Nike sportswear and stuff like that. Okay, 361 brand, under 361 brand. Okay, so they actually took out this money to support their distributor and retailers. And to me, this doesn't really make sense. I think I'm not sure which business actually go out, take out their own money and support the suppliers. Okay, but this is one of the business that we could not answer. We could not really understand the rationale and the logic behind. And of course, after that, we actually decided to sell at a huge loss. Okay, and we bought at about this period. Okay, and of course at the time when we bought was at somewhere around here, and actually we lost about close to 40% in this company, and that will come up to close to 300,000. It was a very painful mistake. And of course the share price today has continued to drop. Of course along the way has recovered a bit, and today we are actually looking at about 150. We bought at about 5, 6, at that range, and if we were to keep it until today, of course that investment would become a lot worse. Okay, and of course if you look at the valuation today for this company, it is trading at price to earnings of 5.6 times and price to book of 0.45. Do you want to invest? Okay, so and the yield comes out to be about, I think, 5 to 6%. Okay, so again, these are the companies that I have my first-hand experience investing in them, and I lost money. Okay, basically this investment become a value trap, and we lost a lot of money. And and then we wasted our time, wasted our resources in this company. Okay, so these are the companies that you will want to avoid, okay, because this company usually trade at a low valuations for a reason. Okay, I mean, I can't accuse the company, you know, for whatever reasons here, but I will not touch because I just find a lot of red flags on this company. Okay, so and this actually brings me to the next point where what are the value trap companies look like, okay, and this is one of them. Okay, I think by now a lot of us should be aware, and but I still have to repeat because those of you who are new to investing, you may not be aware. Okay, so how they look like in Singapore stock market, in Malaysia, how the value trap companies that potentially could become value trap, how they look like are basically those companies that are Chinese listed company in either in Singapore or in Malaysia. And in Singapore we call it S-chip. In Malaysia we just call it Chinese listed companies listed in Malaysia. And B-chip for basically for those companies, Chinese companies that is listed in Hong Kong, that is owned by private entrepreneurs, it's not by government. Those are owned government are called red chip. Okay, so and then they have all kind of shares. I mean, L share is for those Chinese listed company listed in London. They call it L share, and N share is for those in the US like Nasdaq and stuff like that. Okay, so how they look like for value trap companies, I think this is one type of value stocks that you might want to avoid because it's really well known by now that there are a lot of Chinese companies that were listed in Singapore actually came here not to do proper business but to cheat investors money. Okay, so so this is your first type of companies that potentially could become a value trap. So I would say don't waste your time in these companies. And if you look at some of the companies that have been suspended, it has been released in by Straits Times, by all those newspaper publications. You have in Singapore, you have Fibercam Tech. Okay, one of my friends also invested in this company during the 0809 crisis, and then that investment turned out to be a sour investment, even when he bought during the crisis. Okay, and then you've got Irata Lifestyle. That was when, through my observation, this company actually came out a lot of red flags, and one of them was they actually issue convertible loans at double-digit yield. Okay, so that was the first huge red flag that came out. Okay, and of course, there were a whole list of companies that already be suspended. It will be too late now. I talk to you guys, but these are basically what they have in common is those are all S-chips. Okay, so and I'll explain to you. Most of them are S-chip. You have some Indonesian companies. Okay, and of course those were listed in Malaysia. You have Xingquan International Holding, and then of course some of them are not in the list. Of course, like the China Stationery, which is in the list. Okay, so these are all companies that recently has been in the very funny. I would say there were a lot of reflex, okay, and has been suspended, and some of them are actually in the U.S. stock exchange. Okay, and one thing these companies all they have in common, most of them they have in common is this: if you look at their financials, okay, and what they will show is for the first few years, okay, when they first listed, they will have a very, very beautiful numbers. Revenue is growing, profit is growing. This is basically, Xingquan is actually listed in Malaysia, and there's one investor that I know, a blogger that actually heavily promoting this stock because he believed that this stock is a very good investment. When I look at it, there was still a lot of red flags, and they will be raising a lot of money despite the fact that they're earning money. Okay, so one thing that's ironic about this company is that they are making so much money. They are telling that they are growing. They have a lot of growth story in China, and they're making very good revenue, good numbers, and yet they still keep on raising money from the capital market. This is one of the huge red flag they can actually catch for this type of Chinese listed company outside of China. Okay, and then you have HB Global. First they will tell you good number, then they list it, they raise money from you, and then later part they will start to come up with some weird patterns that they say that they report losses, they have to write off the inventories. And I think just 2 weeks ago, I came across this article by Laura, under CIMB, and it was a very good article. I really encourage you to read this article. You just need to Google it, the title, from starving pigs to disappearing chairman. Basically, all these Chinese companies that are trying to cheat people money, they came out with all sort of funny reasons to tell you that they are not profitable, they have to write off, and then some of them, they also run away with the money. Okay, so one of the particular company was very funny, which I would like to share with you, is that this farming companies. They're in the pig business, and they could not feed the pig. They are running out. They don't have enough money to buy the feeds, and all the pigs basically died. And they have to write off those amount. Okay, so and some of them, they will come and tell you that they can't produce the report because all the senior executive, even the chairman, went missing, and the business license, financial book, and official seals all got vanished. Okay, some of them will come up with these funny reasons: no money to pay the audit fee, and some of them factory got burned down, the truck carrying the accounts got robbed. Okay, or they come up all this kind of funny reason. Okay, so basically my advice to you is that if you're looking at any S-chip companies in Singapore or Chinese listed companies based in Malaysia, I would say ignore those companies that are smaller in market cap. Okay, because essentially if you look at the business, you read the business, you realize that it doesn't make sense. It is best to avoid them because all these are very, very fishy, and these are the biggest value trap in my opinion. Okay, after the penny stock, second biggest value trap. And the reason why a lot of such Chinese companies listed outside of China and trying to fraud people money is because they get away with it. Okay, and I encourage you to go and watch this show called China Hustle. It's by Netflix, and basically this video, they actually did a documentary that about those Chinese companies that listed outside of China and how they actually do fraud. And out of those 400 Chinese companies that do fraud, only one go to the jail. Okay, so it's very easy for them to do fraud and they get away with it. That's why it is very convenient for them to come up with a sexy story, list the companies outside of China, and then start to raise money and then run away with the money. Okay, so this is how they do fraud outside of China. As long as they don't break any Chinese rule in China, they will not get caught. They will not have to serve the jail. Okay, the jail term. Okay, and this is the real thing that is really happening, and this is really a good documentary, and I really encourage you to watch it. Okay, so the first value trap stock looks like this. Basically, they are S-chips. Okay, so I won't say all the S-chips are bad. Okay, it's just that you have to be really, really careful if you are really intending to invest in any of the red chip or S-chip either in Singapore or in Malaysia. Okay, you have to proceed with caution, but in my opinion, I would not waste my time. Okay, and the second value trap stocks basically are those companies that managements are lousy. Okay, just put it that way. They do not know how to manage your money. They hold onto the cash. Okay, they pay themselves a lot, and of course there are many patterns that comes with it. Okay, so we have written a lot of articles regarding this area. Okay, you can just go to the website fitperson.com/management reflex. Okay, you can actually go to see my colleague Kenny wrote a really good article on how you can actually spot those lousy management. Okay, so basically there are 5 things that some management, they like to sell you dreams, they set unrealistic targets, and sometimes some companies, they also stray away from their core competency because basically they are good at this thing and decided to diversify into non-core competency. A lot of time the money that they have in the company will be put to waste because they diversify into sectors that they are not good at. Okay, and sometimes they also overpaid for the acquisition, and they may buy back shares at a very high valuations. And I think the most important thing is that they overpaid for themselves. Okay, so there's a huge misalignment of interest between the management and the shareholders, and these are the companies. When you spot management, such management in the companies that invested, it is best to avoid them because these are the businesses that usually, from my experience, turns out to be also a value trap. Okay, they may not lose a lot of money. I mean, the share price may not go down a lot, but over time, the value of the company will just keep diminishing over times. Okay, so I share story with you this company called Company H. Okay, so these are real companies that is listed. Okay, but I cannot mention the name because I'm gonna make a very strong accusations here. But to me, in my opinion, these are very badly managed company. Okay, I don't want to mention names. Okay, basically this company H is listed in Singapore Stock Exchange. They own a very popular tissue brand in Singapore. Okay, I cannot mention the name. That's enough. Okay, they diversify into non-core businesses, and they even went into basically they're the distributor, and they went into unrelated business like health solution consultancy, basically healthcare sector, and then they went into property development. They've got a lot of cash in the company, okay, and they invested into investment in some of the metal companies, wireless, telecommunications. And one thing I noticed about this guy, the founders, I mean, I'm not sure whether he's the founder, the chairman, is that he is paid on the holding company that is trying to invest into so many other businesses. At the same time, he also took a substantial stake in two of the investment that were listed in Singapore. Okay, and then he installed himself as a director in those two companies, and those companies he also get fees from managing those businesses. Okay, to me, this management is really not aligned with shareholders' interest. It's just destroying the value in the company. Okay, first, he doesn't know how to run businesses. He diversified into non-core business. Second, he's there just to take salary. Okay, I would say that he's pretty much like he's very comfortable. He's retired, and then you have these few companies that is giving him money every single year. Okay, and one of the very well-known investors in Singapore also invested in this company. Okay, I'm actually quite surprised he actually invested so much money there. Okay, so that's it. That's enough. I can't give you too much clue. Some of you already, you may guess those companies, but I'm not going to, one of Gabriel, you got it right. Okay, but I cannot mention the name here. But basically stay out from that company. Okay, and the other companies that I can share with you, this company called S. Okay, those of you who attended our workshop, you will probably know what this company is. Basically, this company listed in US, and the CEO is basically a very well-known guy. Okay, and his company, when he IPO, is a social media company basically. Okay, it's quite popular, the app that is used by a lot of youngsters, and that company that he was managing back then was making a net loss of about 3.4 billion, and he paid himself about close to 800 million. Okay, I'm not sure whether you want to put your money with these people, because those companies that is running is basically making losses, and yet this guy is overly paying himself. Okay, so these are what I would say, that these are companies that is huge value trap. Okay, all you want to do is basically avoid those companies. Okay, and another company that I can share with you is a company called Y. It is listed in not Hong Kong, it's in Singapore. Recently, I think got suspended. I think the CEO got caught under investigation by CAD. But this was one of the company where I would say the CEO, ex-CEO back then, was really a dream seller, because he was telling me that the company's platform is a lot even better than Facebook, because they actually merge e-commerce and gaming together. Okay, and the users growth base is really growing really much faster than Facebook. Okay, so those are the companies that I would say a huge big value trap if you invest in them. Okay, so you want to stay out of them. For company S, a lot of you got it right. Okay, okay, and then for Y also, a lot of you got it right. Okay, we've got a lot of smart people in this webinar. Okay, Kevin is not that company. Okay, Kit, you got it right. Adrian, you got it right. Okay, YL, you got it right. Marco, you got it right. Okay, Karina, you got it right. Okay, so those of you who still do not know, but basically these are the signs. If you have any companies in your portfolio that have this kind of characteristic, you want to avoid that, because you do not want to invest in a lousy management, because those lousy management will just destroy value over time. Okay, you may buy at a cheap valuation, low PE, low PB. At the end of the day, they're going to destroy all those value over time. Okay, give them enough time, they will be able to destroy them. Okay, because basically their interest is not aligned with you, and sometimes they are just pure stupid. Okay, they don't know how to run the business. They are just inherited with it. Okay, so and okay, next will be companies like, I would say these are another class of companies that may potentially become a value trap. I would say those are like cyclical business. And I actually learned this the hard way, because I actually invested in this company called Mabel. And I thought that this company was cheap back then, because it was trading at low PB, right? And the earnings was really depressed, because shipping sector has been down for years. Okay, so those companies in the shipping companies are basically companies like in Singapore, you have FSL, Mabel, in Malaysia, Pacific Basin, in or in the Hong Kong Stock Exchange. Okay, so the thing with this industry is that it can be very cyclical. Okay, shipping, oil and gas, and these companies, when they invest, I mean nothing wrong with these companies, right? It's just that the industry they're in is really very tough. Okay, I mean you can put the best people. In my opinion, Maybach has a really good people in the company, but the industry they're in is just too competitive to fight. Okay, so what happened here is that when the shipping market is doing well, a lot of ship prices will increase. Okay, because the freight rate increase, the value of the ship will increase, and then more and more people will order new ships. And when they order new ship at a time when the ship prices, the freight rate is high, the ship prices of course will come at a very high prices. Let's say for example 100 million. And next year when the shipping industry freight rate crash by 50%, the value of the ships, technically speaking, if they were to revalue at that point of time because the freight rate got lower, the ship prices will have to be depreciated by half because the freight rate has actually become lower, because the ship they are yielding in terms of revenue that they are getting is actually a lot lesser because of the lower shipping rate. So even this type of company, if you buy them at low price to book ratio of less than 0.5 or 0.8, at the end of the day, when the cycle crash, okay, your book value is going to have to be written off. Okay, of course in the shipping industry you don't really write off your book value because the shipping doesn't mark to market. But actually if you put it that way, by right it should be, you know, just like property, when the property prices, the rental market collapse, the property valuation will have to come down. Okay, so that is the reason why I think cyclical business, if you were to purely investing based on low price to book ratio, it may not work out so well, because shipping industry or cyclical industry can be very tough because you're dealing with global supply and demand. And whenever there's an oversupply issue, no one can come in and control. It's not like one country, like for example within Singapore, if there's oversupply of property, government can come in and cut down, reduce the supply. But if you're talking about shipping, you're dealing with global supply, okay, and no one have a final say on how much supply is going to have. Every player, as long as they get money, they can actually pump in new supply, and the situation would not just get recovered. Okay, so I would not say I wasted, but I invested in Maybach for almost 4 years, and I lost 70% of my money there. And I realized that this is industry is very tough to be in if you're companies that is really have this kind of similar pattern in the portfolio. And I would say that I would rather invest in those companies that can give me more predictable earnings, and I don't have to be greedy to to make a lot of money from those investments, but I'm happy if I can achieve more than 10% on a CAGR basis. And basically I try to outsmart the industry, being in the cyclical industry, and from time and time again I realize that I'm the stupid one. Okay, so it's very difficult to time the cycle, especially in the cyclical sector. Okay, so that is enough for the cyclical stock. Okay, so basically this is also another type of value trap that I would say you might want to avoid. You might not want to have it in your portfolio because it's very difficult. And the other group is of course those businesses that has been disrupted. And when I say disrupted, basically businesses that has been out of trend, or companies like newspaper. Let me just give you some examples, so to give you some idea. Okay, so we actually invested in this company called TVB, I think about 4 years ago, and 3 to 4 years back. And TVB basically they monopolized the market share, about 81% market share in Hong Kong. Okay, and a lot of us actually watched TVB when we were young. And this company back then when we invested, it was actually giving us a yield about 6.3% for a company that have near monopoly in Hong Kong market. Okay, so but what we didn't realize is that this business, one thing about televisions, the TV that you're watching now at home, if you're still watching, which I doubt so, those of you who are tuning into this, most of the time you probably will watch Netflix, or you also probably watch through YouTube, through tablet. You no longer watch through just those typical televisions that give you a schedule that 8 to 9 or 9 to 10 to watch this show and that show. Okay, so one thing about this sector is that it has been disrupted by advertising. Okay, and we didn't realize that. We actually invested our money there, and then soon 2 years later, 3 years later, we sold it and then we cut loss. I think this loss was about close to 15% net of the dividends that we have received. But it was really a good lesson for us to learn that those business that has been disrupted, most of the time, over time, the earnings will just keep dropping lower and lower. Okay, so you may buy it cheap. At the end of the day, when the earnings drop, your PE will look very, very expensive. You may buy at a low price to book ratio, as over time, when the earnings drop, when they get into losses, your book value will drop. The book value itself will keep dropping and dropping. Okay, so again, if you have owned any share in this type of industry like televisions, TV is one of the best example. I would say this has been actually disrupted. Even in Singapore, you have MediaCorp. That business, of course, is a private business. I would say that it's a disrupted business has been disrupted. Okay, and of course, in Singapore, there's also one more company called Asian Pay TV. This is a company that is very popular. I think a few years back, a lot of our members, our readers actually asked me whether they can look at APTT, okay, with Asian Pay TV, because it was yielding at double-digit yield, and they have a very good market share in Taiwan. Okay, they have a good franchise of cable TV Taiwan at about 68%. So I say a lot of people are still watching those TV, okay, but the younger crowds, if you look at the trend today, the younger crowds, the millennial, even people like me, my sisters, they are all, none of them are watching TV anymore, except my uncle, okay, who is in his late 60s, early 60s. They were still very reliant on the traditional TV. Okay, so this business will not be out of business overnight, but over time you can see that the business will just keep coming out and out because there's a change of consumption behavior among the customers. At the same time, there is also the players like Facebook and Google is actually disrupting this place. Okay, if you are talking about Malaysia, this is one of the perfect example. Media Prima, they own 7v3, and then some of the channels that I think a lot of Malaysians watch. Again, the business that they're in has been disrupted. Okay, basically how they make money is very simple. They sell, because there are a lot of people who are reading and watching the products that they have created, so they sell advertising. And of course, through advertising, that's where they derive a bulk of their revenue comes from. Okay, in Singapore, of course, SPH is also one of the business that has been disrupted. I mean, more and more people are consuming less news nowadays. I mean, you don't just get news from one source. There are many multiple sources that you can get. And the biggest disruption for all these players is not really the change of consumer behavior, but rather players like Facebook and Google that actually stole away their market share. Like a lot of people are using Facebook, Google, and when the entrepreneurs or businesses advertise their product or services in this Facebook and Google, they realize that the result is much more effective. At the same time, the cost is much lower as compared to what the TV, radio, or newspapers are charging. Okay, so that's why there's a huge switching trend for people to advertise from traditional advertising to digital marketing. Okay, so this is why Facebook dominate a huge market share. Google also huge market share from this area. Okay, so this industry has been disrupted. If you have any of those companies in the portfolio, I will say over time this business will just get weaker and weaker. All right, and next, of course, the telecommunication industry also has been pretty much disruption going on. I think the first disruption that we get to see now is that we are using WhatsApp. Actually, you just need to observe your own behavior if you're investing in those telcos. Are you using more phone calls, or are you using more like free call from your WeChat or WhatsApp? Okay, for me personally, when I call for my parents who live in Indonesia, I usually do it through WeChat or WhatsApp. Okay, so it's all free. Okay, I just need to connect to the internet. So last time telco derived a bulk of their revenue comes from overseas call. Nowadays, this segment has been fully disrupted. At the same time, the cable TV like StarHub also has been disrupted because of players like Netflix. People want to watch show at their own time, own target, and then you've got tablets. People like to watch when you're traveling. Okay, so all this sector has been disrupted. And telco is basically a sector that's also going through disruption. Okay, so in Singapore, you have Singtel M1, which recently has been privatized, and then followed by StarHub. Okay, so if you invest in other sectors, of course, you need to ask yourself whether the business that you invested are they being disrupted, okay, or are they a disruptor? Of course, preferably they are the disruptor, okay, and of course, they industry like transport also, even like ComfortDelGro, which dominate a huge market share in Singapore. Who knows, today they're actually being disrupted by Grab. and Gojek. Okay, so of course Uber no longer around. Now it's in Singapore, it's Grab and Gojek. Okay, and of course even for the department stores is also a business that has been disrupted. Okay, I think it actually has long ago has been disrupted by shopping mall. Okay, so this is basically a business that still survives until today, Parkson. Okay, and they have 3 companies. One is listed in Hong Kong, this one is Malaysia, and then followed by Singapore, no, Hong Kong, and then followed by Singapore. Okay, so this business 3 years, 4 years ago, people also asking me, hey, Rusmin, can we invest? Can we look at Parkson because it's trading at price book of 0.5 times? They've got a lot of cash, no debt. Okay, this is a typical deep value stock, cigar butt approach where it's really, really cheap, and the bulk of their book value is basically made out of cash. Okay, again, if you invest in this type of company, I would say it has been disrupted, and it's really, really tough to come back from there. Okay, so I will not touch that. Even for retail industry, it has been disrupted by players like Amazon, Alibaba. Okay, of course, the kind of degree of disruption you need to assess. Okay, you cannot just purely say that e-commerce coming in, all the retail business was out of business. Okay, you can't just do it that way. Okay, in fact, in the retail shopping market in Singapore, Malaysia, and Hong Kong is still quite vibrant. Okay, and of course they are taking away some of the market share, and it's something that you need to monitor as an investor. Payment industry, right? Master, Visa. Okay, if your companies, the companies that you invested that let's say print cash, hard cash, because I know one actually listed in Malaysia that actually print cash to the government. Like that business soon will be declining trend. Okay, because nowadays people are using cashless payment transaction. Even in the Hong Kong also, there's this company that actually issue the smart card. Okay, I mean these are the business actually has been disrupted. And this kind of businesses, usually those companies that tend to trade at low PE, low PB, and when you filter those PE, low PB, low PB, you're gonna end up with a lot of businesses like this. Okay, and they all has been disrupted, and they are trading at a cheap valuations for a reason. Okay, I'm referring to normal market circumstances. Okay, so like Buffett said, the time is the friend of wonderful company, the enemy of mediocre company. If the business has been disrupted, you would not want to invest in those companies. Okay, so now the question is, what is more important is that how do you avoid those companies that could potentially become value trap? Okay, so I show you some of the companies, how to identify them. Okay, and now I'm just going to show you how to avoid them. And this is the same question that Grace asked also. How do you identify value trap, which I will show you how. Could you share with me some example with us? I also share with you some of the companies before that. And when you realize your stock is a value trap, do you sell it immediately? And the answer to that is yes. Okay, but you have to be very sure that the company that invested has been disrupted. Okay, so if you just mere slight disruption, okay, and the stock is still giving a very good value, it's still fundamentally quite sound, you wouldn't want to sell it. Okay, but if you realize that that business is really disrupted, you are buying it because you're holding it because you have invested quite a lot of money, then I would say that it's better for you to clear the investment. Okay, so these are the some companies. Again, just summarize it: S chips, okay, or P chip, or whatever chips that you can find. Okay, I would avoid those Chinese companies that is privately owned, and the business, when you read it, is very fishy. You cannot verify them. Okay, don't avoid those companies. And then cyclical business is really very difficult to outsmart the cycles. Okay, and a business that's been disrupted, you may want to avoid them. And of course, lousy management. Okay, when I say lousy management, it could be those management that is really out there to cheat your money. Okay, so and how we avoid those investing in value trap is, of course, we use our framework called investment quadrant, where we look at the good businesses that have good economic moves, they have a long runway, and they are run by good people, and the interests are basically aligned with you. And of course, the financials are also very sound, very profitable, they generate very healthy return on equity, and also they're trading at a very reasonable valuation. Okay, so, and of course, the best way to avoid value trap stock is to stop filtering those companies that are trading at a low PE or low PB, because you're gonna end up with a lot of junk companies down there. Okay, so I realized that over time, those companies that perform really well in my portfolio are those companies that have good quality, that can show earnings growth or cash flow growth over time. Okay, so those are basically the ideal place that you want to be in. Okay, so again, I'm going to open the floor, question for the floor. if you have any questions, just feel free to ask them. And I just realized that I actually taken more than about 45 minutes. I'm so sorry, because I really got a lot of content to share with you. Okay, so if you have any questions that you'd like to ask me, feel free to ask me here. Okay, so I already have some question coming in. Okay, maybe I'll just show you my face, so at least you've got something to see rather than just a plain screen. Okay, so Peter asks, how do you tell whether the managements are not basically diversifying to other non-core, if I understand your question correctly? Basically, if you invest in F&B business, right, and the management are really good at F&B business, and then one day they tell you that they want to go into property development, and they want to venture into sectors that they're not familiar with, and this is what I would call diversification. Okay, so you wouldn't want to invest in that, and those are basically the companies that you may want to avoid. And then ask, okay, city development is a cyclical in nature, okay, because city development is basically a property development company in Singapore, and the share price has been falling with a low PE and low PB ratio. Will it become a value trap company too? Okay, so city development, I think they have investment properties that they have in their portfolio. This company, I will not say that it's very, very cyclical. Of course, they're in the cyclical sector. They are developer. They're still very subjective to the cycle of the property in Singapore, in times where like now is already a down cycle, so property players are generally not doing so well, and that's why they're trading at low PB, low PE ratio. Okay, and for this type of companies, I like to look for those companies that have a very sizable amount of investment properties in their portfolio, and they actually can give them a very good rental income. So at a time when they're not doing well, they still have a lot of money that is coming into the company that will help to sustain the business, that will help to prepare themselves for the recovery. Okay, so basically they still have in a good net cash position, and those are the companies that you might want to focus in. Okay, so city development, I don't think is a value trap, but that company is, I would say that about of their revenue also comes from development. It can be quite cyclical in nature. Okay, Marco asks, is Perennial a value trap stock? And well, that companies is the companies that, well, on a hindsight, it will be easier to tell, I mean, 5 years later, whether it will be a value trap. Today, the companies have been so far been trying to develop some of the properties that they have done, and they got some project delay here and there about a couple of years, and then the deal didn't work out with capital, and of course that few incidents that actually came out to get them to become a produce of very bad results in their income statement, and they are essentially trying to do a lot of trading, flipping of property, buy and sell. And just basically the short answer to that is, at this stage it's hard to tell whether it's going to be a value trap, but if the management is not focused on what they are doing at now, it could potentially become a value trap. But if they were to focus on executing their Chinese project, okay, and bring in the stable income source, and this could be a good potential long-term investment. Okay, so for now, it's really depend whether you want to wait or not. Okay, so they have a good management down there. And of course, I still have, okay, Wei-Ping asks, is SPH a value trap since the current business has been displaced and they're going into different business to reinvent themselves, and what to do with SPH if we still own the share? For me, SPH, I will only value their property business. I will call them as Singapore Property Holdings rather than Singapore Press Holdings, because property it becomes a big part of their revenue. I mean, 3 years ago, 5 years ago, my answer to you is still the same. I will only look at SPH from the book value of their investment properties. Okay, so those are the value that I will put it. I will put a value in that. Okay, for their advertising business has been disrupted. Okay, so if you are holding on to that, I think I wouldn't invest in SPH in the first place. Okay, if I'm interested to look at SPH property, I will rather look at SPH REIT. Philip, I like your question, because you say, can you tell us what companies in Singapore that we have to avoid? Basically, those that I was reluctant to share. Okay, I cannot tell you so publicly. I'll be in trouble, you know, if because my opinion, I'm very opinionated when I share those companies. Okay, so yeah, I'm sorry, but those of you who got it right. I mean, we discussed some of these things in our workshop. Okay, so if you come to the workshop, you should know some of them also. Okay. And Joe asked, how about property counters like OBLN? Okay, and it's trading at price above 0.5. Founders own about 80%. Is this a value trap? I don't think OBLN is a value trap because they have a lot of investment properties that is actually recurring in nature. Okay, so if the cycle recovers, then that is going to be a bonus for you. Okay, and of course you have to watch out for the debt for OBLN. Okay, so. And okay, really a lot of questions. Okay, let me try to answer. Okay. What is your opinion on trade war, and will companies like Intel be affected? Okay, I've never really looked at Intel in depth, but I know that they are chip producer, chip manufacturers. The trade war, the way I look at it is things are turning bad because recently China just the Huawei just got affected by the ban from the US government, and I think that is getting more and more serious. But again, if you are investing in those companies that very niche in nature, that's not going to be affected by the trade war. Trade war, when the worst happens, share prices across the board may drop. Okay, and that would be actually present you a very good opportunity to pick up those companies. So, for example, like REITs in Singapore. I mean, those obviously, some of them, in fact, I would say that most of them are not affected by the trade war thing, right? Because you're dealing with physical property in Singapore, and you know, those again, trade war. If it really happens badly, you will actually open up a new opportunity for us to invest. Because there's no point worrying how the trade war is going to turn out to be, because it's really very difficult to predict the outcome. Rebecca asked, what is your view on SingPost? Okay, basically, are you asking whether SingPost is a value trap? I would say yes, it's a value trap because they have a dying mail business and they tried to venture into e-commerce business by the previous ex-CEO, and then it didn't turn out so well because those investments that he had acquired previously have actually been written off, and that company is still stuck. Of course, a new management come in trying to turn around a business. I wouldn't put my money there because turn around certain turns, okay, it's very, very difficult. Chip asks, how do you filter companies, good companies for investment? Okay, so there's no shortcut to that. Of course, I would like to give you a shortcut. Okay, but again, you need to understand the framework that we are using. Okay, the investment quadrant. Okay, you need to understand the company business. You know, we have to put in a lot of effort and hard work to find those good companies, and there's really a not shortcut. Okay, last time I started off with low PE, low PB, and then I realized I invested in a lot of I wouldn't say a lot, but a few of the junk companies that I realized that, you know, it's a time wasted. And nowadays I focus a lot on more quality companies, and a lot of quality companies are actually listed in US and of course outside of Singapore. Okay, so there are a few of them also in Singapore. Okay, so is Oxley a value trap? Okay, nowadays your questions are really very, very specific. You are asking me every one of the companies to see whether it's a value trap. Okay, I'm not an expert in spotting a value trap. I have to tell you that. I know the characteristic, the sign which I've shared with you, but I have not looked at all the companies around the world. You guys are asking a lot of companies. China Bank, is it a value trap? SIA, is it a value trap? Okay. I mean, I can only pick those that I roughly quite familiar. Okay, and then I will share with you my opinion on those companies. Is Oxley a value trap? I always thought that Oxley took on too much debt. Okay, they one day could be got themselves into a huge trouble, and then now they're trying to let go, reduce the debt because of the rising interest rate. I have not been following them, but I don't think it's a stock that I would personally want to invest because there are better property investment companies out there. They are a lot more stable, more predictable net cash position than Oxley. Okay, Oxley, to me, they are really a risk taker. The Raymond asks, is the company that I showed earlier on, the Y, is it a value trap? The CEO was arrested. Yes, Raymond. Okay, and then they Liak Peng asks, is it a good time to buy REITs now? The answer is no, because a lot of REITs share prices have gone up. I would not look at REITs today. Okay, so Kevin asks, is S for SingPost? No, Kevin is not. Okay, is Valuetronics a value trap? I have never looked into that in depth of Valuetronics, so I have no comment on that. Okay, David asks the best questions. Any good company you guys are looking at now? Okay, I will keep you into suspense on that questions. How do we know? Okay, Guo Xuan asks, how do we know whether the managements are overpaid? Is there a benchmark that the managements are overpaid? Yes. First, if you ever come across those companies that are making losses and the management paying themselves millions of dollars, those are basically companies that you want to get rid out of it, blacklist them. Okay, so those are very obvious ones. Okay, those are not obvious ones are those companies that they may make like 5 million, and then the management themselves pay 1 million, 2 million, and you only make so much profit, like 5 million, and then you yourself take a big chunk. As a rule of thumb, I would not like those management to have more than 10% of their salary as compared to the overall profit for that year. Okay, so I try to find those companies that the management pay themselves below 10% of the profit. Okay, so smaller companies, of course, they may actually fail a lot of companies, because smaller companies, they may only make 1-2 million. Again, those small companies usually I'm not interested unless they have a very niche business. Okay. ML asks, is Costco shipping Hong Kong has a lot of cash but doesn't seem to be doing well? Is it a value trap? Again, value trap is those companies that you hold in the portfolio. If the share price did not perform well, doesn't mean they are value trap. Okay, sometimes you just take time to realize it. For Costco shipping, if they were to use the cash and acquire lousy companies that are not yield accretive or earnings accretive, that could potentially become a value trap. Okay, or the management decided not to pay the dividends, that could become a value trap. Okay, so far they are doing that. It's just that the market didn't really appreciate that. Okay, so is okay, this is the very, very good question. CK asks, any advice on the recent allegations around Bestwell? The failure to declare family relationship between business and difficulty around measuring the real demand amongst consumers and the way sales are being recognized by the firm. Okay, so basically, I think Bestwell is a M&M company listed in Singapore. The funds that we used to manage back then actually invested in them, but we actually cleared them because first, I personally don't really like M&M companies. I don't like the way they distribute their products. Okay, through M&M model. I mean, this is just a personal thing. And second is that I find that the products that they have is generally not value adding, at least from my own opinion. And third, if you look at Peso today, I think the China, the brand Doctor something is doing well. I mean, whether can you justify, can you actually verify that it is something that is beyond my competence? Okay, and so far the short seller actually did a very good write-up that there's actually a relationship between the founders, and there's basically this so-called RPT transaction that is going on. I think this is really a big question mark down there, and I really have no comment on Beso, but personally I will stay out from Beso. Okay, I will not see as an opportunity even if the share price collapse and then it's trading at a very good valuation. Okay. Wei Ping asks, is dairy farm still worth considering given the supermarket business is not doing well, but the new management has been formed? In such cases, do we wait for the transformation to happen and see result before we look at it again? For dairy farm, I think the supermarket business is experiencing some form of disruption. So this is something where I think dairy farm is actually having challenges. Of course, they have other businesses that actually are doing well, like the Guardian business, IKEA and all that. Okay, so is it better to wait for the transformation to happen? Okay, if you can wait until the transformation to happen, but by then the share price may not be where it is today. In fact, if the share price is still where it is today when the transformation already happened, that will be a really good opportunity. Your risk will be lower there as compared to now, because we do not know whether the transformation will work out for them or not. Okay. Cheat asks, do you encourage short selling? No, okay, because to me short selling is a speculative move, because your downside risk is unlimited, because the share price can literally move up if the insider really want to go against you, like what happened to Olam, okay, and someone shorted, I can't remember which short seller sell it, and I think after that Temasek actually decided to buy out. In the end they probably lost a lot of money for short seller. Okay, so okay, okay, let me try to answer 2 more questions, okay, before I wrap this up. Okay, let me pick a better questions. Okay, so you mentioned that you used to invest in low PE, low PB, but have since evolved. So what are the qualities you look for in the company? Okay, so like I said, I like to look for those businesses that are niche in nature. They have a very good, strong economic moat. Okay, and those companies usually they are in the industry that is enjoying tailwind, or they are not being disrupted. Okay, I mean, if you can just look at some companies that we look at, like symmetry business. Okay, it's really boring industry. Okay, but we actually invested one of it in actually Australia, and it's so far the investment has been doing quite well, because it's not, that industry will not get disrupted. Okay, so basically they have a good market share in Australia as well. Amy said, okay, it's not really a question. So Victor at the AGM, good to see you guys for the talk. Oh yes, Amy, we attended a lot of questions, okay, a lot of AGMs, and talked to the management and assess them. All right, and okay, last questions. And is Kingsman Creative going into area outside of their competency, since they just announced a poor sales result? Okay, so Kingsman moved to venture into some of the experience business, going to the retail business, renting a place. It's outside their, I would not say outside their core competency, it's still within their core competency, because they are in the experience business, they do interior fit out and all that, but they have actually ventured into a new business model, which I think that the risk is a lot higher as compared to that before. Okay, so that venture, if it didn't work out, it may actually affect Kingsman share price. Of course, if it works out, then things will be different, and this is the risk if you're investing in Kingsman that you need to take note of. Okay, so yeah, okay, so that's it I have for tonight's webinar. Okay, if you really enjoy this tonight's webinar, please let me know in the comments, so at least we know that we can do more webinar like this in the future. Okay, so I hope you really enjoy yourself tonight, and you really learn a lot of lessons. And of course, if I don't have a chance to answer your questions, please feel free to join us in the next webinar, and I hope to see you guys again. Okay, so thank you so much. I really very happy to see a lot of you say thank you and really enjoy this lesson, and please do it more. Yes, we will do it more. We have more topics to come. If you do have any suggestions, just let us know. Okay, we try to cover them. Okay, so very good, very happy to see a lot of you like this webinar. Okay, so thank you so much, and have a very good evening. All right, see you guys again